Imagine running a business where for every single dollar that comes through the door, you keep roughly 69 cents in pure operating profit.
I mean, that's just an absurd number.
Right. You don't have sprawling manufacturing plants to maintain. You don't have like massive warehouses full of physical inventory gathering dust.
No complex, easily broken global supply chains.
Exactly. You just have pure, frictionless digital margin. If you hear those economics, you probably assume we're talking about, a scrappy, hyper-growth Silicon Valley tech startup that just invented a new category of software.
Oh, absolutely. That's the immediate assumption.
But we aren't. Today, we are looking at legacy financial institutions that make modern big tech look, well, incredibly inefficient.
Yeah, the economics of the companies we are examining today are almost entirely divorced from the physical constraints that govern 99% of the global economy. I mean, they operate in a completely different reality.
And that is exactly why we are here. Your listener shared a deeply researched, really fascinating internal investment memo with us.
It's an incredible piece of research.
It really is. This memo provides a rigorous comparative analysis of three absolute titans of financial data. We're talking about S&P Global, Moody's, and MSCI.
Right. The big three.
Yeah. And as we were going through the research you sent over, what stood out immediately wasn't just the sheer scale of these businesses, it was the underlying structural architectures that allow them to, extract so much cash from the global financial system.
Well, and our mission today, which is based entirely on the framework in the memo you provided, is to determine which of these three entities appears strongest for long-term, risk-adjusted compounding.
Okay, but before we dive in, we need to adopt a very specific lens for this, right?
Oh, absolutely. This requires putting aside all the daily noise of the stock market. We're not looking at next quarter's earnings estimates.
Right.
We aren't discussing stock price momentum, and we certainly aren't chasing macroeconomic fads. We're putting on our most rational, patient, and skeptical hats here.
So really channeling that disciplined Buffett-style analysis of business economics?
Exactly. We are looking for structural permanence.
Which means before we can even begin to compare S&P, Moody's, and MSCI, we have to establish the rules of engagement. I mean, we need to define the standard.
Yeah, we have to know what we're actually measuring them against.
Right. So based on the memo you sent, what does long-term investment quality actually mean in practical mechanical terms?
Well, the memo lays out a very clear, uncompromising framework. It starts with the absolute foundation, which is high and durable returns on capital.
Okay, durable returns.
Yeah. In practical terms, this means we are looking for a business that consistently earns 12 to 20%, or even higher, honestly, on its invested capital over multi-decade periods.
Let's freeze there and unpack that mechanism for a second, because it's a concept that gets thrown around a lot but is rarely actually explained.
It's very misunderstood.
Yeah. When we talk about compounding in this specific context, are we just looking for the company that can grow its top-line revenue the fastest? Like, is this just a race to see who can scale their sales team and acquire the most customers year over year?
No, not at all. The distinction between growth and compounding is actually where most casual analysis totally falls apart. They are profoundly different mathematical realities.
How so?
Sustainably. They don't do it through temporary accounting maneuvers, and they don't just ride cyclical economic peaks. Growth is it's actually only valuable if it generates returns above the cost of that capital.
Meaning, if I have to borrow money at 8% interest to fund a new project, or if my shareholders expect an 8% return, but the new project I invest in only generates a 6% return.
You're technically growing your revenue.
Right. My company is getting larger.
But you are actively destroying shareholder value with every single dollar you spend. You are building a larger, less efficient machine.
That makes total sense.
Yeah. True compounding means the underlying economic engine produces excess cash. And this is the crucial part. The business has avenues to reinvest that excess cash at those same extraordinarily high rates of return.
So it is an internal wealth creation engine.
Exactly.
Okay, so we aren't just looking for a company that is getting bigger. We are looking for a company that is getting fundamentally denser with value. What is the second pillar of this standard?
Resilience under stress. The business model cannot rely on blue skies. I mean, we have to see how it operates in a hurricane.
We need to see the storm testing.
Right. We want revenue that is largely recurring, which the memo specifically refers to as toll booth economics. The product must be deeply embedded in the daily workflow of the customer, creating practically insurmountable switching costs.
So they can't just easily leave for a competitor.
Exactly. We want to see steady, inelastic demand even in brutal economic cycles. Demand driven by strict regulatory compliance needs or indispensable, globally recognized benchmarks.
So it's basically the financial equivalent of a public utility. Like you might cut back on eating out during a recession, but you don't turn off the electricity to your house.
That's a perfect analysis. We are looking for the electricity providers of the financial markets.
And once you have that resilient cash flow, what's next?
You need the third pillar, which is a robust reinvestment runway. Generating a mountain of cash is a wonderful problem to have, obviously.
Sure, I wouldn't mind that problem.
Right.
Yeah.
But if the business operates in a tiny, saturated niche, that cash just sits there earning absolutely nothing. There needs to be a large, expanding, addressable market to deploy that capital into, whether through organic product development or highly disciplined M&A.
Which flows right into the human element of the equation. I mean, we need management teams that possess intense capital allocation discipline.
Yeah, management teams are essentially the custodians of the compounding engine. Their discipline is paramount. This means making sensible strategic acquisitions that actually fit the core architecture of the business rather than, engaging in ego-driven empire building.
Which happens a lot.
Oh, constantly.
Ah.
It also means having the humility and rationality to return excess cash to shareholders through buybacks or dividends when internal projects don't meet that high hurdle rate we just discussed.
Knowing when to shrink the business by divesting a low-margin unit is probably just as vital as knowing when to expand.
100%. And then there's the final piece of the puzzle, the overarching protective layer for all of this.
Right, the moats.
Exactly. Structural competitive advantage. Real, tangible moats. We are not looking for a company that is just currently executing better than its rivals. We want barriers to entry that are basically baked into the legal, regulatory, or network infrastructure of the industry.
So the advantage must be structural. Completely insulated from, say, a well-funded startup trying to disrupt them with a new algorithm.
Precisely. It has to be structural.
Man, that is an exceptionally high bar. High returns on capital, extreme stress resilience, a vast runway for reinvestment, ruthless capital allocation discipline, and infrastructure-level moats.
It really is the gold standard.
We are evaluating these companies against an ideal that very few businesses on Earth can even approximate. So let's lift the hood.
Let's do it.
Let's look at the actual economic engines of S&P Global, Moody's, and MSCI and see how they actually extract money from the economy. The memo you sent us categorizes S&P Global as the diversified tool booth. Let's break down why.
Well, S&P Global's economic engine is essentially a hybrid. It's built on two distinct, massive, incredibly high-margin toll booth franchises, which are then supplemented by a third, lower-margin data business.
Okay, what are the two main franchises?
The first major engine is their credit ratings division. The second is their indices division, which oversees products like the S&P 500.
The numbers in the memo give this an incredible sense of scale. Let's look at the projections for 2025.
Yeah, the numbers are wild.
S&P's rating segment is estimated to pull in roughly $4.7 billion in revenue. But again, revenue is just the top line. The operating margin on that $4.7 billion is roughly 64%.
Unbelievable margin.
And then you look at the indices segment, which brings in about $1.85 billion, operating at an even higher margin of around 69%. Let's pause and explain the mechanics of that 69% margin.
Yeah, we should.
How does a business keep almost 70 cents on the dollar? Like, what does the cost structure actually look like?
Think about the fundamental nature of an index. S&P, it serves a committee of experts and utilizes complex methodologies to create a list of 500 large U.S. companies. They maintain the data, calculate the weightings, and publish the list.
Right.
The cost of generating and maintaining that list is relatively fixed. It involves salaries, data servers, and technology infrastructure.
So the cost is the cost, whether one person looks at the list or a billion people look at it.
Precisely. Now imagine Vanguard or BlackRock wants to create an exchange-traded fund, an ETF, that allows retail investors to buy the whole S&P 500 in one click.
Which millions of people do.
Exactly. To do that, Vanguard has to legally license the S&P 500 name and methodology. They pay S&P Global a licensing fee, typically a fraction of a percent, just a few basis points, on every single dollar invested in that ETF.
So if $1 billion flows into an S&P 500 index fund, S&P Global collects a percentage of that flow.
And here is the magic of the margin. S&P Global doesn't have to hire more analysts, build more factories, or buy more raw materials to service that new $1 billion.
Because the list is already made.
Right. The marginal cost of that next dollar of revenue is effectively zero. The revenue scales infinitely while the cost base remains relatively flat. That operating leverage is what produces a 69% margin.
Okay, so they have these two pristine, high-margin toll booths, but the memo points out a significant drag on this engine. It's not all 60+% margin.
No, it's not.
S&P also operates a market intelligence unit, their data, research, and analytics software products. And this unit operates at a much weaker margin, hovering around 20%.
Quite a drop.
Yeah, why would a company with two near-perfect businesses attach a 20% margin business to their balance sheet? I mean, it feels like they are deliberately diluting their own perfection.
It does dilute the peak profitability, undeniably. But we have to look at what that data business actually provides. The market intelligence unit, which was massively expanded by their acquisition of IHS Markit Embed's S&P, directly into the daily operational workflow of millions of financial professionals.
Okay.
Analysts use their terminals, their data feed, their supply chain software every single day.
So it's about building a broader ecosystem. Think of it like a tech platform. You own the two most exclusive, lucrative toll roads in the country. You own the only bridge into the financial capital and the only tunnel out. Every time a transaction passes, you take a massive cut.
That's ratings and indices.
Right. But to keep people in your ecosystem, you also operate a sprawling network of diners, gas stations, and rest stops along the highway. That's the market intelligence unit. The rest stops are operationally heavy, you have to hire more staff, deal with more competitors, and the margins are much lower.
But they provide a vast, stable baseline of recurring subscription revenue. And they create immense stickiness. If an entire investment bank integrates S&P's market intelligence data, feeds into their proprietary trading algorithms, ripping that data out and switching to a competitor becomes a multi-year, highly disruptive IT nightmare.
No one wants to do that.
No. The data business requires heavier operational lifting, but it builds a wider, deeper foundation for the overall enterprise. S&P basically trades peak margin for structural breadth and integration.
Which presents a perfect contrast to our second company. If S&P is trading peak margin for structural breadth, Moody's takes the exact opposite approach.
They really do.
The memo categorizes Moody's as the cyclical powerhouse. Let's examine their economic engine.
Well, Moody's essentially operates a two-part model. They have their own credit ratings franchise, which is an elite oligopoly mirroring S&P's ratings business, and they have an analytics and software division focused on integrated risk assessment.
The overarching strength of Moody's, according to the memo, is their sheer, unadulterated profitability. I mean, their overall adjusted operating margin for the entire company, not just one segment, was roughly 51% in 2025.
It's massive.
Furthermore, their free cash flow exceeded 30% of their revenue.
To contextualize that, if a typical Fortune 500 company converts 10% of its revenue into pure free cash flow, they are generally considered quite healthy.
Right, 10% is great.
Moody's is converting over 30 cents of every dollar into unencumbered cash that they can deploy however they see fit. It is a phenomenal wealth generation engine.
But the memo immediately raises a massive red flag regarding the architecture of that engine. 37% of Moody's total revenue is classified as deal-related, as opposed to the 63% that is recurring. That feels like a significant vulnerability.
It is the defining vulnerability of the business model. When we say deal-related, we mean their fortunes are inextricably tied to the transactional volume of the global debt markets.
Let's walk through the actual mechanics of that. Imagine I'm the CFO of a major multinational corporation. Interest rates are at historic lows, the economy is expanding, and I want to issue $5 billion in corporate bonds to fund the acquisition of a rival company.
Okay, so to sell those bonds to institutional investors, like pension funds, insurance companies, you need a credit rating. The investors demand an independent assessment of your ability to pay them back.
Makes sense.
So you hire Moody's, you pay them a substantial fee, often based on the size of the bond issuance, to analyze your balance sheet and assign a rating. That is a deal-related fee.
So in a booming economy with low interest rates, corporations are constantly refinancing old debt, issuing new debt for mergers, and expanding operations.
Right.
The deal flow is just a fire hose, and Moody's is standing right underneath it with a bucket, collecting massive transactional fees.
The cash flow in those environments is staggering. But, the inverse is equally true. What happens when the macroeconomic environment shifts?
Right. What if inflation spikes?
Exactly. Or central banks aggressively raise interest rates, and the cost of borrowing skyrockets. Or what if a sudden liquidity crisis freezes the credit markets entirely, like we saw briefly in March 2020, or during the depths of the 2008 financial crisis?
As that CFO, I look at the new 8% interest rate and say, never mind. We aren't doing the acquisition. We aren't issuing the $5 billion in bonds. We'll just use the cash we have and wait it out.
And the very moment you make that decision, Moody's deal-related revenue from your company drops to zero.
Wow.
Their model is incredibly profitable, but it is acutely sensitive to the macroeconomic cycle. They do not have that second, non-correlated, massive toll booth that S&P possesses with its passive indices. Moody's relies far more heavily on a single macroeconomic lever, which is the continuous flow of global debt issuance.
Let's pause and look at the internal mechanics of what happens to Moody's during that freeze. The revenue drops, but what happens to their costs? This is where the concept of the operating leverage trap comes into play, isn't it?
Yeah, the mechanics of that trap are pretty unforgiving. Moody's operates a vast global infrastructure. They have thousands of highly compensated credit analysts, expensive real estate and global financial hubs, and massive data and technology overhead.
And those are largely fixed costs.
Exactly. You cannot simply fire half your sovereign debt analysts because issuance slowed down for a quarter. You need that expertise on staff to maintain the integrity of the ratings ecosystem.
So the costs remain high and relatively static, but the top-line revenue from deal flow evaporates.
Which means the damage falls entirely on the margin. When revenue drops 10%, profits don't drop 10%. They might drop 20 or 30% because those fixed costs consume a much larger share of the shrinking revenue pie.
That's painful.
The memo notes that in a severe, sustained credit downturn, Moody's phenomenal 51% margins could drastically and rapidly compress down to the mid-40s or even lower. The engine is powerful, but it runs on a very specific type of fuel.
Okay, so S&P is the diversified hybrid, sacrificing a bit of peak margin for a wider, more stable base. Moody's is the hyper-profitable, pure-play powerhouse that lives and dies by the cyclical flow of debt. Now, let's examine the third player in the memo, MSCI.
The focused innovator.
Right. They're categorized as the focused innovator.
If S&P and Moody's are fundamentally rooted in the fixed income and corporate debt plumbing of the world, MSCI is fundamentally tethered to the global equity markets and the rise of passive asset management.
So they are playing a different game.
Completely. They are an index and analytics provider. Think of the MSCI World Index or the MSCI Emerging Markets Index.
The memo states that roughly 57% of their top-line revenue comes from their indices. But the true economic power is in the bottom line. The firm estimates that those indices account for more than 70% of their total operating profit.
It is an incredibly concentrated, highly efficient engine. And unlike Moody's deal-based revenue, MSCI's index fees are overwhelmingly asset-linked and recurring.
Let's clarify asset-linked. This means their revenue isn't based on a one-time transaction. It's based on the total value of the money sitting in funds that use their indices.
Exactly. If a massive sovereign wealth fund allocates $50 billion to a strategy that explicitly tracks the MSCI World Index, MSCI takes a microscopic percentage fee on that entire $50 billion year after year for as long as the money sits there.
Wow.
It acts less like a traditional software subscription and more like a permanent financial annuity.
Which totally explains the metric in the memo that simply blew my mind. A client retention rate of over 95%.
I mean, a retention rate that high almost defies the laws of competitive capitalism. It speaks to absolutely insurmountable switching costs.
Why is it so hard to switch? Let's say I run a massive ETF that tracks an MSCI index, and a competitor comes to me and says, hey, we built a very similar index, and we will charge you half the licensing fee. Why wouldn't I take that deal to save millions of dollars?
Because changing the underlying benchmark of an established investment fund is a logistical and regulatory nightmare. You have to change the fund's prospectus, which requires regulatory filings and board approvals.
Sounds expensive.
Oh, very. Plus, you have to communicate the change to millions of retail and institutional investors, many of whom bought the fund specifically because they trusted the MSCI brand name to accurately represent that specific market segment.
Right. They want MSCI.
The legal costs, the brand risk, and the operational friction of changing the benchmark far outweigh whatever marginal savings the competitor is offering on the licensing fee. Once you are embedded as the benchmark, the client is essentially locked in.
So the core index business is an absolute fortress. But the memo points out that MSCI is actively trying to build new businesses outside of that fortress. They are pushing heavily into ESG, environmental, social, and governance data and climate risk analytics.
And this is where the economics of the business begin to fracture a bit. The ESG and climate data markets are currently experiencing massive secular growth. There is tremendous demand. However, the economic reality of supplying that data is vastly different from licensing a passive index.
The memo notes that the margins in the ESG and climate data segments are hovering around 20% and actually ticked down slightly from previous periods. Why is there such a massive discrepancy between the 70+% margins of the index business and the 20% margins of the ESG business?
Because building an ESG rating requires intense, manual, subjective analysis. You are evaluating corporate supply chains, carbon footprints, board diversity, and labor practices across thousands of global companies.
You can't just automate that easily.
No, you can't. It requires an army of analysts and constant, expensive data ingestion. Furthermore, the market is highly fragmented and fiercely competitive. There is no single universally agreed-upon standard for ESG in the way there is a standard for the S&P 500.
So it's kind of the Wild West.
Exactly. MSCI is fighting trench warfare for market share against dozens of nimble competitors, and that lack of pricing power and high cost of execution drags their margins down heavily.
Okay, so we have a really clear map of the three economic engines. S&P is diversified but burdened by a massive lower margin data operation.
Right.
Moody's is hyper-profitable, but tethered to the volatile cycle of debt issuance. And MSCI has a flawless asset-linked annuity engine, but is bleeding margin to fight a ground war in the unproven ESG space.
That's a perfect summary.
These engines are all generating massive cash flows today. But a true long-term investor doesn't just look at today's cash flow. They look at the fortifications protecting that cash flow for the next 20 years. So let's talk about durability and the quality of their moats.
Yeah, the analysis of moats is where we separate a good business from an immortal one. We need to distinguish clearly between moats built on structural permanence and moats that rely on constant operational execution.
Let's define those terms because they are crucial to understanding the memo's conclusion. What is the fundamental difference between an execution advantage and a structural advantage?
So an execution advantage means you are currently winning because your management team is smarter, your sales force is hungrier, or maybe your software interface is slightly faster than the competition. You are just running the race better.
Okay.
But execution advantages are inherently fragile. Your star CEO can leave, a competitor can poach your best engineers, or a startup can build a slightly more elegant software tool. You have to wake up every single day and fight to maintain an execution mode.
So it's exhausting, and eventually regression to the mean catches up with you.
Exactly. A structural advantage, however, means the barrier to entry is woven into the very fabric of the ecosystem. It is regulatory, or it relies on deep network effects where the product becomes exponentially more valuable simply because everyone else is already using it.
You don't have to run faster than the competitor. You own the track they are trying to run on.
That's exactly right.
Let's apply that lens to the businesses. I want to spend time on what I think is the most fascinating revelation in this entire analysis. When we look at S&P's index business or MSCI's index business, we often think they are selling data or mathematical accuracy, but they aren't, are they? They are selling something much deeper.
They are selling consensus, and consensus is perhaps the most impenetrable moat in modern finance.
Let's dive deep into that, the index network effect. How does selling consensus actually work as a moat?
Think about the role of an index in the global economy. When a pension fund manager in Tokyo, an investment banker in London, and a retail investor in Ohio all want to talk about how U.S. large-cap stocks perform today, they don't look at a random assortment of companies.
No, they all look at the S&P 500.
Exactly. S&P Global doesn't just provide a list. They define the very language the market uses to communicate.
It's basically the financial equivalent of the English language.
Precisely. If you want to launch a new ETF or write a derivative contract or benchmark the performance of a mutual fund manager, you must use the universally accepted standard.
Even if you don't want to.
Right. Even if a brilliant mathematician at a tech startup creates a structurally superior, more accurately weighted index of 500 U.S. companies, it is utterly worthless unless they can simultaneously convince millions of global financial professionals to abandon the S&P 500 and adopt the new standard.
Which is practically impossible because the value of the S&P 500 isn't that it's a perfect mathematical model. The value is that everyone agrees it is the market. You are locked in by the collective agreement of the entire planet. That is a profound structural advantage.
And that exact same dynamic applies to the credit ratings businesses of S&P and Moody's. The memo refers to Moody's moat as monopoly-like. It is an elite quasi-oligopoly shared primarily with S&P.
Why is it so impenetrable?
Because, much like the indices, credit ratings are a deeply entrenched standard of consensus, reinforced by decades of regulatory reliance.
Let's push on that. Let's play out a hypothetical. Say I have unlimited capital, I hire the smartest risk analysts from MIT, I build an AI model that predicts corporate defaults with 99% accuracy, vastly outperforming the legacy models of S&P and Moody's.
Okay, great model.
My product is objectively scientifically better. Why can't I disrupt them and steal their market share?
Because, in the fixed income market, an objectively better rating from an unknown entity is completely useless.
Really?
Yeah. Institutional investors have investment mandates, often legally binding rules written into their charters, that state they can only hold investment-grade bonds.
Okay, and how do those charters define investment grade?
They explicitly define it as a bond carrying a specific rating from Moody's, S&P, or Fitch.
So the moat is literally written into the legal plumbing of global capital pools?
Exactly. Furthermore, the ecosystem requires trust that has been forged over decades, often through severe crises. When the 2008 financial crisis hit, the rating agencies took immense reputational damage for their role in rating mortgage-backed securities. Yet, they did not lose their dominant market share.
Wait, that is incredibly counterintuitive. They failed spectacularly at their core job, faced congressional hearings, paid massive fines, and yet their moat remained intact. How does a business survive that level of failure?
Because the market realized there was absolutely no viable alternative infrastructure. Regulators tried to reduce reliance on the big agencies, but investors still needed a standardized, universally recognized language to assess risk.
They're trapped.
The institutional inertia was so massive that the market essentially accepted the flawed agencies over the chaos of having no standard at all. If surviving the 2008 crisis didn't break the ratings oligopoly, it is hard to imagine a technological innovation that could. It is the very definition of a structural, infrastructure-level moat.
Okay, so Moody's has this indestructible quasi-monopoly moat in credit ratings. S&P has the exact same ratings moat, plus the consensus network effect of the S&P 500. So here is where I have to play skeptic based on the memo's analysis.
I love it. Go ahead.
The memo suggests Moody's has the strongest single moat in the ratings business. Historically, they have often commanded a slightly higher market share or deeper pricing power in specific debt tranches than S&P.
That's true.
If I am an investor looking for pure safety, shouldn't I just want the company with the absolute thickest, deepest single moat? Like, why wouldn't Moody's be the undisputed winner?
Well, that tension is the central analytical pivot of the entire memo.
Yeah.
It all comes down to the danger of concentration risk versus the safety of structural diversification.
Yeah.
Yes, Moody's has an arguably purer, slightly deeper execution within its primary moat,
Right.
but that purity means its entire economic fate is tied to one single variable, which is the volume of global debt issuance.
We are back to the cyclical vulnerability.
Exactly. S&P, conversely, chooses not to rely on a single perfect fortress. They trade the purity of a single moat for the systemic safety of two distinct moats.
So it is about engineering a system that survives when one specific component fails.
Right. If the credit markets freeze, Moody's phenomenal moat stops generating revenue. The moat isn't broken, no competitor is stealing their clients, but the river of commerce flowing through that moat simply dries up.
Which is still a huge problem.
Exactly. S&P has engineered a structure where, if the debt markets dry up, they still have the massive parallel river of the global equity markets flowing through their indices toll booth. S&P sacrifices a fraction of peak margin and operational simplicity to ensure that a localized macroeconomic shock cannot cripple the entire enterprise.
That makes perfect logical sense. You want the fortress that guards two different trade routes, not just one.
Precisely.
Where does MSCI's moat fit into this hierarchy?
Well, MSCI is a spectacular core moat in its flagship global indices. The network effect there is virtually identical to S&P's. However, their structural advantage is a bit narrower. Outside of that core index business, as we discussed, they are relying heavily on execution moats in the ESG and private asset data spaces.
So they are more exposed.
Yeah, they do not have a second structural monopoly to fall back on if the trend toward passive investing were to suddenly reverse. They have one incredibly deep moat, surrounded by a lot of unprotected territory they are trying to defend with sheer operational hustle.
So the moat hierarchy is clear. S&P offers the most robust structural diversification. Moody's offers the purest but most concentrated monopoly. MSCI has a narrow but incredibly powerful network effect that they're trying to expand into highly competitive arenas.
Well summarized.
But a moat, no matter how deep, is essentially worthless if the management team inside the castle is burning the furniture to stay warm.
Ah.
We have to look at capital allocation. How do these leaders behave with the billions of dollars their moats generate? The memo you shared is particularly focused on S&P Global's management discipline. What makes their approach so unique?
The hallmark of an exceptional management team is rarely found in the glamorous acquisitions they make. It is usually found in the unglamorous things they choose not to do and the assets they choose to sell.
Interesting.
S&P Global, under former CEO Douglas Peterson and continuing with current CEO Martina Chung, has demonstrated a ruthless, highly disciplined reshaping of the company's architecture.
The memo specifically highlights their exits from J.D. Power and McGraw-Hill Education.
Yes, and those divestitures are the perfect example of capital allocation discipline. McGraw-Hill Education and J.D. Power were recognizable, cash-generating businesses. Many CEOs would have held on to them simply to maintain top-line revenue growth or to satisfy their own desire to manage a larger empire.
But S&P look at them and realize they didn't fit the mold.
They realized those businesses lack the extreme tollbooth economics and structural moats of their core ratings and indices segments. They required more operational effort for lower returns on capital. So management made the hard, disciplined choice to prune them.
They shrank the top line to improve the structural quality of the bottom line.
Exactly. They refined the empire rather than blindly expanding it. And they used that focus and that freed up capital to execute the massive IHS Markit acquisition, which deeply deepened their core data ecosystem.
But here is where I have to push back a bit.
I'll go for it.
The memo highlights a staggering figure. From 2023 to 2025, S&P Global returned over $15 billion to shareholders via stock buybacks and dividends. $15 billion.
It's an astronomical sum.
If I own a business that generates the kind of astronomical returns on capital we just discussed, why on earth would I give $15 billion back to the shareholders? Shouldn't a visionary management team be reinvesting every single cent back into their own amazing business to grow it even faster?
That is a very common, very rational question, but it ignores the physical limits of their specific economic engine. Remember the zero marginal cost dynamic of the index business.
Right.
It takes very little capital to run. You cannot simply spend $5 billion to invent a second S&P 500. The market only needs one standard.
Ah. The reinvestment runway has physical limits.
Exactly. The structural moats of S&P and Moody's operate in relatively mature, saturated markets. They cannot aggressively reinvest all their massive cash flows organically without suffering severely diminishing returns.
So they'd just be wasting the money.
A lesser management team would take that $15 billion and buy unrelated software companies or attempt to enter entirely new, highly competitive industries just to keep growing. They'd effectively destroy shareholder value by earning poor returns on that capital.
The classic diversification.
Right. S&P's management recognizes the limits of their organic reinvestment runway. They acknowledge that beyond strategic, highly synergistic acquisitions like IHS Markit, the most rational, value-creating action is to simply hand the excess cash back to the owners of the business. That requires immense discipline and, frankly, a total lack of ego.
Okay, let's contrast that aggressive share reduction strategy with Moody's approach. The memo describes Moody's capital allocation strategy as build and prune. They lean much more heavily into mergers and acquisitions.
They do.
They have acquired companies like Bureau van Dijk, RDC, and Cape E to build out an expansive, integrated risk data platform alongside their ratings business.
And Moody's management is highly respected, right?
Yeah.
They have also returned substantial capital and pruned underperforming units. However, their reliance on continuous acquisitions to drive growth in their analytics segment introduces a layer of accounting opacity that requires really careful scrutiny.
This is where we need to explain a crucial accounting mechanism, because the memo explicitly flags this as a potential vulnerability. The memo notes that Moody's acquisitive nature has left a massive amount of goodwill on their balance sheet.
Right.
For a listener who doesn't spend their days reading 10K filings, what exactly is goodwill, and why does a high level of it make an analyst nervous?
Goodwill is a very specific accounting concept. Let's use a physical world example. Imagine you want to buy a highly successful corner bakery.
Okay, I love a good bakery.
The ovens, the building, the flour inventory, the physical assets, they might only be worth $100,000. But the bakery generates massive profits because everyone in the neighborhood absolutely loves their bread. So the owner won't sell it to you for 100,000, they demand 500,000.
Because I'm buying the brand, the customer loyalty, the future cash flows.
Exactly. So you pay 500,000. On your balance sheet, you record the 100,000 in hard assets, the remaining $400,000. The premium you paid over the fair market value of the assets is recorded as goodwill.
So goodwill is essentially a mathematical representation of the premium you paid for future expectations.
Yes. And the danger arises if those future expectations don't actually materialize. If a new bakery opens across the street and your profits plummet, the auditors will look at your balance sheet and say, that $400,000 in goodwill is no longer justified by the reality of the business. You are forced to take an impairment charge, which writes down the value of the goodwill and hits your reported earnings massively.
So when the memo points out Moody's high goodwill, it's warning us that a significant portion of their balance sheet is built on the optimistic premiums they paid for other companies.
Correct.
If those acquisitions underperform, the accounting reality will violently catch up to them.
Furthermore, heavy M&A can mask the true organic health of the core business. If you look at top-line revenue growth and see a seemingly healthy 10% increase, you have to dig deeper and ask, how much of that growth was actually generated by the core business organically improving? And how much is simply the new revenue you bought by acquiring 3 companies last year?
It's like a farmer boasting about how much larger his crop yield is this year, but omitting the fact that he just bought the neighbor's farm fully grown the day before the harvest.
Right. It obscures the true compounding rate. It creates noise. It makes it harder to ascertain the true underlying return on invested capital. S&P's approach of organic focus combined with aggressive share buybacks is analytically cleaner and mathematically more certain than a strategy reliant on continuous premium-priced acquisitions.
Which brings us to the governance structure of MSCI, which is entirely unique among these 3. MSCI is a founder-led company guided by CEO Henry Fernandez.
And under Fernandez's visionary leadership, MSCI has executed brilliantly. I mean, they have grown profitably, capitalized on massive secular trends, and actively bought back stock. But the memo highlights structural governance risks that are inherent in their specific setup.
The primary concern raised is the concentration of power. Fernandez holds the combined roles of chairman of the board and chief executive officer, and there is a significant founder family presence. Why is that structure viewed with skepticism in a comparative analysis like this?
Well, in a mature, widely held public corporation, the role of the board of directors is to act as an independent check on the CEO. They represent the shareholders. When the CEO is also the chairman of the board and is a deeply entrenched founder, the friction that normally exists to temper bad ideas is drastically reduced.
There is basically no one in the room with the structural authority to tell the visionary founder no.
Exactly. That lack of strict outside oversight poses 2 major risks. The first is bias risk, the risk that a company might pursue aggressive, ego-driven acquisitions or push too heavily into unproven low-margin areas, like their intense expansion into ESG data, right? They might do that without facing rigorous pushback from an independent board. The second, and perhaps more systemic risk, is succession.
Key man risk. The entire strategic vision, the corporate culture, and the operational momentum are deeply tethered to the unique intellect and drive of one specific human being.
When that individual inevitably steps down, the transition can be highly turbulent. The company has to fundamentally learn how to operate without its architect.
That's a huge adjustment.
Huge. Compare that to S&P or Moody's, which are institutionalized machines. Their structural moats and operational processes transcend any individual CEO. They are systems designed to survive executive turnover. MSCI requires you to place a disproportionate amount of faith in the ongoing judgment and eventual smooth exit of a single individual.
So, synthesizing the management pillar. S&P offers institutionalized, ruthless capital discipline and clean returns of cash. Moody's offers strong execution but introduces accounting opacity through heavy M&A. And MSCI offers visionary, high-growth leadership but asks you to accept concentrated governance and significant key man risk.
That's the landscape.
We have dismantled the engines, evaluated the depth of the moats, and scrutinized the architects running the systems. Now we must engage in the most crucial part of this analysis. We have to run simulations.
Time for the stress tests.
Exactly. We need to stress test these businesses against the macroeconomic realities of the future. The memo you provided is brilliant at framing this not as a simple list of risks, but as a series of structural trade-offs. Let's explore the first major trade-off: scale versus innovation. Or framed another way, growth versus stability.
If your primary criteria for compounding is aggressive top-line growth driven by secular innovation, MSCI is the undeniable leader. Just look at the momentum captured in the memo. In the first quarter of 2026, MSCI's index fees were up an astonishing 26.6% year over year.
Wow.
For a company of their size and market penetration, a near 30% growth rate in their core recurring revenue is explosive.
And that growth isn't just a fluke. It's being propelled by two of the most powerful structural shifts in modern financial history. The relentless, seemingly unstoppable migration of global capital from active mutual funds into passive ETFs, and the rising institutional mandate for ESG integration. They are surfing massive macroeconomic
But
waves.
that explosive growth carries an inherent structural condition. Their revenue is fundamentally asset-linked. Their fees grow automatically as the stock market rises and asset values inflate.
But the blade cuts both ways.
Severely. If global equity markets suffer a prolonged structural repricing, say a 25% correction that takes years to recover, the assets under management in funds tracking MSCI indices drop proportionally.
So even if they keep the clients,
Even if MSCI retains every single client, their fee revenue drops in lockstep with the market. They are tethered to the performance of the underlying assets.
so MSCI is the high beta growth engine. Now let's contrast that with the scale players, S&P and Moody's. The memo notes that Moody's demonstrated a very strong 9% revenue growth in 2025. That sounds fantastic for a legacy infrastructure business.
It does, until we apply the stress test. We have to ask where that 9% came from. It was largely driven by a cyclical recovery in global debt issuance. Corporations were rushing to market to issue bonds. The fragility of Moody's growth profile is that it is entirely dependent on the willingness of corporations to take on debt.
Let's run a severe macro scenario. Let's say we enter a 5-year period of stagflation. Economic growth stalls out, but inflation remains stubbornly high, forcing central banks to keep interest rates elevated at levels we haven't seen in decades. What happens to Moody's in that specific environment?
It is the absolute worst-case scenario for their economic engine. High interest rates make borrowing prohibitively expensive for corporations. Stagnant economic growth means companies aren't expanding, acquiring rivals, or building new factories, so they have no need to raise capital.
The deal flow evaporates.
The fire hose turns into a trickle. Companies simply stop issuing new bonds. When issuance stops, Moody's deal-related revenue collapses. And because of the operating leverage trap we discussed earlier, their vast fixed-cost infrastructure of global analysts and technology, their margins are crushed.
Right, because they can't fire everyone.
Exactly. The memo is explicit. In a severe downturn, Moody's elite 51% margin degrades the fastest, potentially compressing down to the mid-40s or lower as fixed costs devour shrinking revenue.
So if we are prioritizing downside protection, the trade-off of durability versus valuation sensitivity, what happens when the music stops for the entire global economy? If we hit that stagflation scenario or a deep global recession, who survives the storm with their compounding engine most intact? Who degrades the most gracefully?
This is the moment where S&P Global's complex diversified architecture proves its ultimate worth. Let's run S&P through that exact same stagflation stress test.
Okay, debt issuance freezes, so S&P's ratings revenue takes a massive hit, just like Moody's. The stock market plummets in the recession, so S&P's asset-linked index fees drop, just like MSCI's. They are getting hit simultaneously on both fronts. Why does the memo suggest they're safer?
Because of the precise contractual nature of their revenue streams and the shock-absorbing capacity of their broader ecosystem. Let's look at the ratings business first. When new debt issuance drops to zero, Moody's suffers acutely because they are heavily reliant on the initial transactional rating fee.
Okay.
S&P, however, derives a massive portion of its ratings revenue from what are called surveillance fees.
Surveillance fees. Let's break down how those function.
When a corporation issues a 30-year bond, they don't simply pay S&P a one-time fee to rate it on day one and never speak to them again. The investors holding that bond require continuous monitoring to ensure the corporation's financial health hasn't deteriorated.
Makes sense.
So S&P charges the corporation an ongoing annual surveillance fee to maintain and update that rating every single year for the entire 30-year life of the bond.
That is an incredible dynamic. So even if the global economy freezes and absolutely zero new bonds are issued for an entire year, S&P is still collecting an uninterrupted river of massive recurring surveillance fees from all the millions of bonds that were issued over the past 3 decades. The historical backlog acts as a financial shock absorber.
Exactly. Now add their index licensing business, which is deeply embedded in institutional mandates, and the sticky subscription-based revenue from their market intelligence terminals.
Yeah.
Even if their peak margins compress from the mid-60s down to the low 50s due to broad market weakness, their cash generation remains immense and highly predictable.
Wow.
S&P acts as its own counter-cyclical hedge. It degrades the most gracefully of the three because its foundation is mathematically wider.
Where does MSCI sit in this ultimate stress test?
MSCI sits firmly in the middle of the spectrum. A deep bear market directly and immediately damages their asset-linked fee revenue. The memo projects that under severe market pressure, MSCI's margins could drop from the mid-40s down into the 30s. This compression is exacerbated by the fact that they must continuously invest heavily in their lower-margin ESG and private asset ventures to fight off intense competition. That creates a drag on profitability, exactly when they need flexibility the most.
But they don't break.
No, they certainly don't break. Their baseline cash flow easily survives because asset managers do not abandon the benchmark just because the market is down. A Vanguard ETF tracking the MSCI World Index doesn't switch benchmarks during a recession. The assets inside the fund simply shrink, and MSCI's fee shrinks proportionally. They survive the storm, but their compounding rate flattens out significantly.
So when we distill all this analysis down, the core choice facing a disciplined investor really boils down to a fundamental philosophical trade-off: predictability versus optionality. Do you want S&P's steady, ironclad predictability, a model where they intentionally sacrifice explosive top-line growth to maintain a diversified fortress, returning mountains of certainty to shareholders via buybacks?
Or do you want MSCI's optionality? A model where your compounding rate will absolutely soar during global bull markets, but where you risk terrifying volatility and stalled growth during sustained downturns.
That is the dividing line. Are you willing to accept significant macroeconomic volatility for the chance to ride a secular growth wave to higher peak returns? Or do you prioritize the absolute certainty of the compounding mechanism, knowing you are deeply protected on the downside?
Exactly. S&P prioritizes the certainty of survival and steady accumulation. MSCI prioritizes maximizing the secular tailwind of passive asset accumulation.
And Moody's is sitting there offering the highest pure operating margins of the group, but demanding that you ride the terrifying macroeconomic roller coaster of the global credit cycle with practically no diversified safety net.
That summarizes the structural reality of the three options perfectly.
So, we have dissected the engines, explored the moats, scrutinized the management, and run the macroeconomic stress tests. Let's step back and look at the entire board. Synthesize this for us. Based on the rigorous comparative analysis in the memo you shared, where are the differences between these three titans wide, and where are they narrow?
Well, the differences in sheer raw cash generation are surprisingly narrow. We must be clear. All three of these companies are exceptionally profitable, financially impenetrable, cash-gushing entities.
They're all incredible businesses.
Absolutely. They possess elite credit ratings, they dominate their respective markets, and they generate free cash flow profiles that 99% of public companies can only dream of. If you had held any of these three assets over the past decade, your wealth would have compounded magnificently.
It is basically a battle between gold, platinum, and palladium.
Exactly. However, the differences in their cyclicality, a foundational stability of their architectures, and their vulnerability to singular macroeconomic shocks, that is where the gap is remarkably wide.
Okay, lay it out.
MSCI is structurally reliant on the ongoing secular rise of passive asset values. Moody's is structurally reliant on the cyclical transactional flow of global debt issuance. S&P Global balances both of those massive opposing market forces while heavily reinforcing its foundation with layers of recurring surveillance and essential data subscriptions.
Which leads to a vital question regarding the nature of their success. Are the traits that make one of these companies appear stronger merely a reflection of the current economic weather? Like, is MSCI only exhibiting explosive growth because we happen to have experienced a historic, multi-year bull market in equities? Or are the winning traits deeply encoded into the DNA of the businesses?
The analysis in the memo concludes that the superiority we are looking for is structural, not incremental or environmentally dependent. S&P's resilience isn't an accident of timing. It is a structural architecture deliberately designed and refined by management over decades.
So it's intentional.
Very intentional. They built a diversified base of mission-critical, heavily entrenched services that naturally offset each other's cyclical weaknesses. Moody's advantage is the structural reality of regulatory reliance. MSCI's advantage is the structural reality of the index network effect. The strengths are baked into the plumbing of capitalism itself.
But the mission of this deep dive is to make a determination. When forced to choose the absolute strongest candidate for long-term, risk-adjusted compounding, what is the final verdict?
Maintaining our measured, rational, Buffett-style framework and relying exclusively on the data and structural analysis provided in the deep dive memo, the final verdict points clearly to S&P Global. It stands as the strongest, most resilient compounding machine of the three.
Summarize the why. Why S&P over the pure margins of Moody's or the explosive growth of MSCI?
Because S&P Global perfectly balances stable, ultra-high margins with structural diversification, while executing incredibly disciplined, massive returns of capital to shareholders. It is an all-weather vehicle. It degrades the most gracefully under severe macroeconomic stress, and it compounds capital relentlessly and predictably in expansive times.
Let's maintain our intellectual honesty here, though. What is our confidence level in this verdict? We are dealing with probabilities, not physics.
The memo is transparent about this. The conviction level is moderate. We are dealing with minuscule margins of superiority among elite assets. None of these firms should be dismissed.
Right, you can't go entirely wrong with any of them.
No, a highly rational, data-backed argument could be made for heavily concentrating an investment in any of them. S&P simply scores the most consistently high marks across every single dimension of our rigorous stress testing. It offers the widest margin of safety.
But every investment thesis, no matter how robust, has a breaking point. What is the single reversing variable? What is the one specific macroeconomic or regulatory event that could happen over the next 5 to 10 years that would force us to tear up this analysis and declare that MSCI is, in fact, the undisputed winner?
The single variable most likely to violently upend this ranking is the future trajectory of passive versus active asset management.
Okay, how so?
Well, if the shift toward passive automated ETF investing accelerates far beyond current projections, like if active management essentially dies and MSCI's indices capture a monopolistic share of all new global wealth generation, the sheer volume of their growth compounding could simply overwhelm S&P's diversified stability.
That makes sense.
Alternatively, if global regulators launch a coordinated, severe crackdown on the issuer pays model of the credit rating agencies, heavily penalizing Moody's and S&P, well, MSCI, which operates outside that specific regulatory crosshair, could easily surge past them in structural quality.
So what we discovered today isn't just an answer to a financial query. We started this deep dive looking for a clean mathematical diagnosis of 3 businesses. But what the memo ultimately revealed is that choosing between S&P, Moody's, and MSCI isn't merely about picking a stock based on a spreadsheet of historical margins.
No, it is a far deeper exercise.
It requires making a profound philosophical bet on the fundamental flow of global capital over the next 20 years. So I will leave you, our listener, with this singular thought to mull over as you view the markets tomorrow.
It's the big question.
Will the next decade of human economic history be defined by the relentless cyclical issuance of corporate debt fueling global expansion, or will it be defined by the unstoppable structural tide of passive equity indexing silently absorbing the world's wealth? The answer to that profound question ultimately will dictate which of these titans truly compounds the best.